Oh, I'm pretty cheerful about the long term for markets. I think we're going to get lower interest rates for longer, and that will help risky assets. But the short term is going to be pretty bumpy.
So what, are we going down? Because I just had Ron William give me some technical stuff earlier on as well. He's talking about 1929, but and 3,000. If we break that on the S&P, then we could be off to the races on the downside. What do you think?
No, I think our core view is still that markets can grind marginally higher from here, as long as the economic recovery is still there. It's going to be slower than it was in recent months because of the uptick in virus cases in the United States. I still don't think people have fully accounted for the impact that will have on the speed of this recovery. But our view is that as long as the recovery can continue to some extent, we will see modest continuing gains for shares. What we're not calling is that rotation into the real economy shares, the value shares that a lot of people are looking for to fuel the next jump up. We think we're going to continue to see the quality and growth lead for the time being until there's some kind of a catalyst to transform the real economy, like a vaccine or a major therapeutic for the virus. So grinding up, but grinding up with leadership still coming from those quality stocks.
Charlie, let me be really glib and throwaway about this as well. Who cares about the economic recovery when there are trillions and trillions of dollars trying to find a home from the central bank's largesse as well? If the money's there and they're getting zip on their bond holdings and gold's through the roof as well, I mean, why don't they just buy equities regardless of that economy?
Well, look, I mean, that's obviously absolutely true, isn't it? We've had this kind of put underneath markets for many years, but we've never had one quite as extreme as this. We've never had one which moves into so many different asset classes as this one does. And it's entirely legitimate to say that the kind of basic price mechanism of assets has been broken by monetary policy intervention, and that will support asset prices. I do think that we need to see evidence of a virus in remission at the same time as we see this huge monetary support in place. Let's remember that whilst central bank money continues to flow, there are some big cliffs coming up in the next month or two in terms of fiscal support, particularly in the United States, still waiting for that stimulus plan to be agreed. So, our view is you do need those twin things. You need monetary policy support, and you need at least some kind of economic recovery in place.
Charlie, even if we do get more support from Washington, which is expected at this point, it doesn't necessarily mean that businesses and households will be comfortable resuming activity. And if you look at the high frequency data, which a lot of bulls were citing a month or two ago as encouragement for getting back into risk assets, some of those data points look as though they've already peaked, suggesting that even if we do have all this support, people are going to be hesitant to resume activity. Yeah. So how do you pair more stimulus with the fact that businesses and households continue to be nervous when they look at the virus numbers?
Yeah, I think that's absolutely true. We can talk about what governments can do, but what are the human behavioural responses at this point that could slow economic recovery? And there's many. People are scared. They're scared of getting sick if they go out of their houses. And they're not going to do that just because the government tells them to do it. They're more used to working at home. They're more used to consuming less things out and about, and that slows economic growth. These behavioural trends don't go away just because governments want them to do. I agree that the high frequency data is suggesting that particularly in the United States, where the virus has resurged, there has been a marked slowdown in the pace of the economic recovery. I don't know if you're yet going to see it in the PMI numbers, because there'll be a bit of a muddle when they come out. But you do see it in high frequency data. How much are people moving around, going into restaurants, footfall in cities? It is slowing down again. And that's the nature of what it's going to be like for some time. It's going to take a long time to unwind people's very human response to this virus. You can't simply put more steroids in the arm of the global economy and get people to take risks with their family. Governments did an incredibly good job, frankly, of scaring us about this virus in the early days. It's going to take a lot to sort of unwind that. Particularly as in the States, obviously Donald Trump has now kind of finally admitted how bad the virus is. So we can expect that the rhetoric about the dangers perhaps to get a bit worse in America in the coming weeks.